Hi, Matt McAleer, President, Director of Private Wealth at Cumberland Advisors. December 22nd, as we count down the last days of 2023's trading schedule. In terms of this week, kind of quiet versus what we've seen previously. Equities did continue to have a bid, especially in that small and mid-cap area. Very strong. Value had a bid. Value outperforming growth. Again, it's that reversion to the mean trade that we've been watching and trying to take part in. Not too much in trading within the equity models this week. Over on the bond side, very interesting, I think, that the 10-year Treasury comes down and touches 380, 382, just about the same level we started the year. And I know John's going to have a 10-year chart up in some of his discussion. But all the hand-wringing, all the predictions about recession, about inflation, what the Fed can do, what the Fed can't do, we're right back to where we were 12 months ago. So in terms of positioning, what we want to try, as always, is to look to where the puck is going, not to where it has been. And in terms of the data we continue to get, and John can touch on, seems like inflation is under control. We watch inflation, we watch interest rates from the equity side because they work together. They complement each other. They work with the dollar, weakening dollar. We like to see that. Often you hear about dollar strength and dollar weakness and what it means to the economy in terms of politics. We try to ignore that. A weakening dollar has been helpful historically for equities, especially this year, and it continues to be. I don't think it's a coincidence that rates and the dollar peaked in October and small caps and mid caps got such a strong bid. And that's continued. So in terms of allocation, everything has held steady in our portfolios and probably will into the end of the year. We can revisit allocations in January depending on movements with multiple asset classes. Next week, next Friday, we're going to revisit some different levels in indices, in asset classes, and take a look at behavior at those levels. Remember, markets move on a number of different things. Often, behavior is not noticed and mentioned in terms of earnings and forward multiples. Behavior, very, very important. And I think by blending that in, we can try to help ourselves going forward and learn, where do we make a mistake here? Where do we make a mistake there? What did we do well here? So we'll do a nice review next Friday. Happy holidays. Enjoy the weekend. See you next week.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday morning on December 22nd, and this is the bond report. This week, yields dropped in the short end, 446 to a 432 on the 2-year Treasury. Continued movement in the thought process that the Fed will be cutting short-term interest rates earlier in the year and perhaps more than was expected just a few weeks ago. 10-year and 5-year yields moved down 3 ticks. They're around a 388. And when you look at this, and especially look at this chart that we have, it shows you that the 10-year bond yield is finishing the year basically where it started, even though you've had tremendous volatility. We saw rates drop in March, along with the problems with the banks, Silicon Valley Bank. And then we saw the carnage this fall when rates essentially rose all the way up to 5% on fear of the Fed. And of course, once the Fed started to say they saw some moderating in the economy, things started to turn around. There's a question out there, does the Fed know something we don't know? We constantly ask ourselves that question. One thing that did come out this week, when you look at the PCE, the Personal Consumption Expenditure Deflator, it is the preferred measure of inflation that the Fed follows, that declined. Month-over-month number, minus 0.1 versus an expectation of 0. Core number also well behaved. So those are good signs. Throw on that, new home sales down 12% month over month. That was a stunner for the market. On the other hand, you had jobless claims a little lower than expected this week. Your durable goods a little higher than expected this week. There's some cross currents out there. But the background is that you need to have this lower inflation to have the Fed really start to move. They will not move until they're convinced that inflation is going to stay on the path at least towards 2% if it doesn't get to 2%. As we close the year, we want to thank everybody for watching this year. We appreciate the opportunity to engage with us, and we certainly always appreciate the opportunity to give you our best efforts in managing money. So we hope everybody has a very Merry Christmas. We'll talk to you before the new year. Thanks a lot.